Assalamualaikum and hi everybody, it's Emma here. In part 1 of this video, I have shared with you the overview of commercial bank, which includes the types of banks, the function of commercial bank, and financial institutions in Malaysia. In part 2, we are going to see what instruments do banks use to generate money and what are banks' obligations. By understanding what items are in a bank account, we can understand how banks operate and makes money. Like other businesses, banks also have balance sheet to give interested parties an idea of the company's financial position. In addition, balance sheet displays what the company owns and owes. So, like other balance sheets, bank must also record its asset, liabilities, and equity. Assets could be used to generate cash flow, reduce expenses, or improve sales, regardless of whether it's manufacturing equipment or a patent. If you learn accounting, you would know things like cash, bank inventories are classified as assets. In bank, their assets items are slightly different. Their asset items are money at calls, bills discounted, government short-term securities, certificate of deposits, investment, loans, and advance and special deposit. Let us look one by one. Money at call. Money at call is a minimum 5% short-term finance repayable on demand, with a maturity period of 1 to 14 days. It is used for interbank transactions. The money that is lent for 1 day in this market is known as call money, and if it exceeds 1 day, is referred to as notice money. Discount bill. Discount bill is a facility offered to exporters who sell on credit. For example, let's say I want to export rubber to Brunei. I agree to sell them on credit, meaning that they don't have to pay first when I ship the product. By right, I have to wait for the payment at an agreed date. Under this facility, I can go to bank and show them my shipping document. The bank could pay me or rather lend me the so-called purchase amount on discount. When the time arrives and buyer pay us, we then pay back the amount we borrowed to bank. T-bills or Malaysia government securities. They are short-term securities issued by government to get working capital. The tenure is normally 3 to 6 months. If CIMB Bank holds MGS, for example, CIMB will get interest. Certificates of deposit. It is a financial product that allows you to purchase the certificate or deposit your money for a certain period of time in bank. In return, bank will pay you interest. Investment is an asset to the banks when they get the dividend over their investment. When a bank sells loan, in return, it basically gets interest and fees. Compared to savings, loan is considered as a bigger asset. Special deposits is just like we have money deposited in many places. Those money are your reserves. Let's now look at liabilities of commercial banks. There are 3 items which are normally liabilities in commercial banks. First, transaction accounts. The transaction accounts are the sum of non-interest-bearing demand deposits and interest-bearing checking accounts. When you and I deposit your money through transaction account, bank must secure our money and be responsible to save them. Second, household or retail savings and time deposits. For example of retail savings are your passbook savings account and retail time deposits. Similar to transaction accounts, they become liability to bank because depositors expect high interest rate when they save in time deposits. Third is negotiable CDs. They are fixed maturity interest-bearing deposits with face value of $100,000 or more. It can be resold in the secondary market. How does it become liabilities to bank? It is because depositors expect even higher interest from their savings. And equity is the difference between bank's asset and its liabilities, and it represents the net worth of the bank or its equity value to investors. Let us recap. In order to understand the financial position of a bank, we have to know what items are in commercial bank's balance sheet. From asset side, banks have cash, money at call, MGS, and so on. On the liability side, banks owe depositors what we save when we save our money there and expect interest from the bank. The difference between asset and liability is equity. That's all. Thank you.